Hey guys, welcome back to the channel. My name is Nakul. Let's go through 13 facts about recessions. Some of these are quite interesting, while we can use others as a guide to help navigate us through future recessions. And one of them just blew my mind. I'm going to focus on recessions in the US because the US is the world's dominant economy, and many economies around the globe depend on the health of the US economy. So recessions in the US normally have widespread and global impact. So you might be thinking, why 13 facts? Why not 10? Why not 20? 13 is just an odd number. Well, the reason I chose 13 is because there have been 13 official recessions declared by the National Bureau of Economic Research since 1945. Now, technically, there have been 34 recessions in the US since 1854 and as many as 48 recessions in the United States, dating back to when US declared independence. But first of all, I don't have 48 interesting facts to tell you, and secondly, and more importantly, determining the occurrence of pre-20th century recessions is much more difficult because of the lack of data available. Major economic statistics such as unemployment and GDP were not compiled on a regular and standardized basis until after World War II. And so many investors look at recessions that occurred after 1945. So, what did I mean by official recession declared by the National Bureau of Economic Research? Well, it turns out the National Bureau of Economic Research has the responsibility of determining when a recession officially begins and when it ends. They define a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. And though this is the official definition of a recession, the accepted rule of thumb for when a recession starts is 2 consecutive quarters of negative GDP growth, or in other words, when the economy shrinks for 2 consecutive quarters. The end of a recession is when GDP stops falling and the economy stops shrinking. The term recession gained popularity after the Great Depression, which lasted for 10 years and ended in 1939. Before this, an economic downturn in the economy was called a depression, which was supposed to be a less scary term compared to a crisis. But after the Great Depression, the term became particularly scary, and economists began to use the term recession instead. Today, the definition of a depression and a recession are different. A recession is seen as a normal part of the business cycle that generally occurs when GDP contracts for a relatively shorter period of time, while a depression, on the other hand, is an extreme fall in economic activity that lasts for years rather than just several quarters. Depressions are often identified as recessions lasting for longer than 3 years or resulting in a drop in annual GDP of at least 10%. All depressions are recessions, but all recessions are not depressions. Now, onto some numbers which I honestly found super useful to gauge what recessions are normally like and to understand what we can expect in future recessions. The average stock market return during a recession is, drumroll please, positive 3.68%.
What? Bro, what are you talking about, man?
That's right, the S&P 500 index gained 3.68% on average during recessions. The S&P 500 has had positive returns in 7 of the 13 recessions since 1945, with the best performing recession being the recession of 1945, where the S&P went up about 28%, while the worst performing recession was the Great Recession, where the S&P fell about 24%. I remember when I first heard about this, my mind was blown and I had to check the numbers for myself. But now that I think about it, this makes sense because the stock market is forward looking and generally falls significantly before a recession because the market's already anticipating a recession, like we are today. Once an official recession is announced, that means that the economy has already been shrinking for at least 6 months and stock market valuations would already reflect this. In fact, a lot of investors believe the right time to invest during an economic downturn is as soon as a recession is announced. For instance, the Great Depression was officially announced on December 1st, 2008, a full year after it had started. The bear market ended just 3 months after on March 6, 2009. The bull market that followed lasted more than a decade. There have been 13 recessions since 1945, which means on average a recession occurs once every 6 years. The biggest gap between 2 recessions was 10 years and 8 months between the Great Recession, which ended in June 2009, and the pandemic recession, which started in February 2020. The smallest gap was 1 year between the recession in 1980 and the recession in 1981. US recessions have lasted an average of about 10 months. The longest recession since 1945 was the Great Recession, which followed the global financial crisis and lasted 18 months. And the shortest was the pandemic recession, which lasted just 2 months. So the last 2 recessions were actually the longest and the shortest recessions, respectively. US GDP falls an average of 4.4% from peak to trough during a recession, with the biggest fall being 19.2% during the pandemic and the smallest being just 0.3% during the dot-com bubble. Though there is no one way to predict a recession, there is one indicator that has predicted every single recession since 1955, with only one false signal during that time. And that's the inverted yield curve. An inverted yield curve means that short-term US Treasuries is paying a higher interest rate than long-term US Treasuries. An inverted yield curve does not create a recession. Instead, it's a representation of how people see the future of the economy. If the general sentiment is that a recession is near, investors will move their money to safer long-term assets, such as the US Treasury bonds. If there are many buyers for long-term treasuries in a relatively short period of time, the yields for long-term treasuries fall below the yield of short-term treasuries, causing the yield curve to invert. Economists often describe different types of recessions with the shape of the market recovery. For example, in a V-shaped recession, the economy suffers a sharp but brief period of economic decline, with a clear defined trough, followed by a strong recovery. In a W-shaped recession, also known as a double-dip recession, the economy falls into a recession, recovers with a short period of growth, then falls back into a recession before finally recovering. Some other popular recession shapes are the U-shaped recession and the L-shaped recession. According to a study by Fidelity, the worst performing sectors during a recession are technology and industrials, which have an average annual return of between -5 to -10%, while the best performing sectors are consumer staples and utilities, which makes sense because no matter what happens in the economy, people still need certain household items and electricity on a recurring basis. Peak unemployment reached an average of 8.8% during recessions, with the lowest being 5.2% during the 1945 recession and the highest being 14.7% during the pandemic recession. The pandemic recession was obviously a very unique situation, and you can see that in the numbers. Even though it was the shortest recession, the GDP fell the most during this period, and peak unemployment was higher than any recession before. Lastly, a recession is a normal part of a business cycle. The four stages of a business cycle are expansion, peak, contraction, and trough. A recession is an economy's contractionary period between a peak and a trough, and is followed by an expansion or bull market. Policymakers and economists work towards increasing the length of an expansion and decreasing the length and impact of a contraction. But unfortunately, periodic contractions in the economy are normal and should be expected. Those are 13 interesting facts about the recession. I hope you found this video useful. If you did, do smash that like button. If you're looking for an investment strategy for the upcoming recession, check out my video on the best investment strategy during recession. I'll see you in the next one.